Hello. Welcome everyone for another Structured Products Insight episode. I have found you here as usual, and I have Natalie Monardo. Again, it's a massive pleasure. So thank you, Natalie.
Yeah, thank you guys so much for having me. I've been following the podcast for a little while, and I think the insights you guys bring are really, really useful. So yeah, I'm very happy to be on today.
Great. So today we're going to do an episode. I've wanted to do it for a while, and Natalie's a very good person to do it with. So she's Sales and Business Development Manager at Leverage Shares EU. She's responsible for sales and distribution of leverage shares and income share ETP. So ETP is, for me, is a big topic. Still part of the structured product family, but slightly different. So yeah. Thank you, Natalie, and hope we can educate a few people and get some insights.
Yes, absolutely.
Wonderful. So we can kick us off. Obviously, like we were saying, we're kind of bigger into the SP side of things. Just for myself and listeners coming in, what is an ETP exactly? How would you define that from a very ground level up? What's the definition?
Right. I mean, first thing we can do is get rid of the acronyms. ETP is literally an exchange traded product. That is what ETP stands for. And most of us say ETF, right? And we say ETF because more than 95 of AUM is in ETFs. ETP is kind of the umbrella term to describe any exchange traded product, and that can be an ETF, so an exchange traded fund. It can be an ETN, an exchange traded note, or it can be an ETC, where the C stands for commodity. ETFs are they seem to be gaining a bit of traction. The narrative is accelerating, becoming a bit more popular. And the funny thing is that they've actually been around a really, really long time. Okay. And when I found out when the first ETF was launched, I was very, very pleasantly surprised, not only because it was launched in Canada, but because it was launched in 1993. So that's a really, really long time ago. And over time, I think both the nature of the product, so the purpose and the types of underlying exposure that exchange traded products provide has evolved to meet the need of investors. And, the reason I actually reached out was mostly because I started to recognize the similarities between some of the newest ETPs and, structured products. So that is kind of where the industry is going. I'm alluding to a lot of things here, but I'll stop here for now.
Yeah, I think one question that we have a lot of advisors come to us for the differences between kind of the UCITS ETF and a non-UCITS ETP. Could you just spend a couple of minutes discussing that and letting us know the difference there?
Exactly. So in Europe, to call it an ETF, it has to meet UCITS criteria. And UCITS is simply a regulatory framework where the purpose is to make sure that the ETF it meets certain standards to make it basically, safe and diversified for the retail investor. And without going into the specific regulatory requirements that need to be met to be able to call it a UCITS ETF, they are basically diversification. So you can't have a single underlying, for example. It has to do with, liquid and transferable securities. So it can't be property. And there are, investor protection rules involved for it to be UCITS, such as the segregation of assets, right? It's really, really basic stuff, but there's a set of rules that you have to meet. And if you don't meet those set of rules or a list of eligible assets, you cannot call it an ETP. And one very simple example of what is a really pretty vanilla and pretty well-known exposure, but is not an ETF, it's an ETC. So it's basically an exchange traded way to get exposure to something like gold. So any commodity. And if you have a single underlying, that automatically disqualifies it from being a UCITS structure, right? Just based on the diversification rule. So ETFs and the UCITS rules are fantastic to have a standard for diversification and to have a standard for investor protection, segregation of assets. ETCs and ETNs, those structures provide a bit more flexibility to issuers to bring to market more creative strategies, single underlyings, maybe I don't want to call it funkier stuff, but different exposures that still add value to the portfolio. And maybe we can then talk about, counterparty or issuer risk and stuff like that.
Why that distinction matters for advisors?
It matters because most advisors are looking for something that they have a check mark, right? But at the same time, if you still need to look for the right exposure for your client, right? And I think the last few years, the race, or not the race, but the desire to have commodity exposure and single commodity exposure like gold. If you limited yourself to a UCITS ETF, you'd probably be getting, a diversified basket of diversified index of gold miners rather than just the gold itself. And to have exposure to the physical commodity, and to have that like specific exposure, which is exactly what you're looking for, you can't always get that in a UCITS ETF. That being said, ETPs or ETNs and ETCs can be UCITS eligible, which means they're eligible to be a part of a UCITS ETF or a UCITS fund.
So let's talk about ETPs, because for me that's something that I track very well. We're talking about millions of products in Europe every year created and expired. And what are the benefits of the ETP wrapper?
In general, it's transparency, liquidity, tradability, right? These are quoted on exchanges, which means they're tradable just like a stock. When the exchange is open, there's a price. And there's a price because there is one or more market makers always providing liquidity on the bid and the offer. And actually, oftentimes exchanges have certain standards for liquidity, right? So they even set certain, bid offer standards for these market makers. So what it is, it's a product that is tradable and liquid, much more so than, for example, a mutual fund that may just price at the end of every day or at the end of every week, where you might put in your order at 12 noon on a Tuesday, but maybe you don't get done or filled until the end of the trading day or the end of the week. And, another thing is also the transparency in terms of the underlying assets, right? You know exactly what it's holding. Most issuers, UCITS, there are certain rules in terms of disclosure of the underlying assets and the fund holdings, but even ourselves, like Leverage Shares only does ETPs, and on our website every day we show the holdings of every one of our ETPs, right? So you know exactly what's in the portfolio.
How do you compare it with the traditional structured products, the investment structured products?
It's the accessibility is a big thing, right? When something's quoted on exchange and your broker is connected to the exchange, it's the barrier to buying these products is much lower. So at least from the issuer side, it's a really interesting wrapper to explore because it improves the accessibility of the product.
So I think the big thing is, we were discussing earlier about how ETFs, ETPs are becoming a bit more widespread. Why is this relevant now? Why is this growth happening now? What do you think the reason behind that is?
Yeah, I think it's important to understand like the story that we've told since like the 90s, 2000s, right? And initially it started as an institutional product, right? It was index-based, an easy way for institutional investors to access something that replicates an index, so index exposure, without the high cost and operational hurdles to replicating an index yourself, right? So you outsource all of that and you buy an exchange-traded product, which comes with all the benefits I already mentioned, right? And that was kind of how it started. And then over time, the industry figured out, well, we can also provide access to new markets geographically, right? So harder to access capital markets. Korea, Malaysia, for example, are great examples. Well, if we can wrap the S&P, we can wrap other indices which are harder to access, and not only geographically, but we can also wrap other products. We already talked about ETCs. We can talk about corporate bonds as well. Like those aren't super easy to access, right? If you have them in an ETP structure, all of a sudden the game changes, right? And it means capital can much more easily flow into these assets, and you can get the exposure that you're looking for. And over time, the initial story the ETF industry told was, and this probably happened after the financial crisis, which was actually probably a linchpin to another increase in the growth rate, right? Because obviously you had some like structured products which didn't go so well, and it triggered, obviously a lot of consolidation in the space. And one of those big consolidations is actually BlackRock buying BGI, which was the owner of iShares, which is the biggest ETF brand on the planet, right? So that was kind of something that increased the pace of growth and increased the adoption of ETFs. And the story we told was, oh, okay, you can now have something transparent, because people were looking for transparent alternatives, but also we started telling the story of the passive index tracker, which has very low management fees, is going to beat over time the active manager, which is very, quite ironic with today's framing because active ETFs are becoming so interesting.
And
So just to like finish my thought in terms of the story of why ETPs are becoming so important. So not only 2008, but we also had COVID in 2020, and we all know what happened in COVID, right? It was the rise of the retail investor. Everyone and their dog opened a brokerage account and started trading, and we all kind of thought that would go away. But it hasn't. And the retail investor is alive and well and looking for products with these characteristics, or a way to invest that's quite easy, accessible, transparent, etc. And there's a stat I looked up just before joining the call, actually, which I thought was really, really interesting on the awareness gap, right? In line with the theme of the retail investor, is something like 64% of UK adults don't know what an ETF is. And that missing knowledge is much more pronounced in the older demographic. And it's the under 35s, which are actually adopting ETFs and have the most knowledge of ETFs at the moment. And this comes at a time when demographically, especially across Europe, but also in the US, you're going to have a big transfer of wealth. So this is, you kind of have a confluence of things, new generation looking at these products. The narrative has been built over many years, and financial education is improving with that demographic, which is about to inherit a lot of money.
That's a very interesting topic, right? Because it's a topic I follow for 2 decades, and I think you're right that the generations kind of invest in different ways. Do you see also the same aspect from ETFs to ETPs? I mean, I'm sure how much data you have from your investors. What is a typical buyer of ETPs?
I think it's harder to decipher, because I don't think it's I don't think the difference between UCITS and non-UCITS is super, super clear. Like, we're battling for people to understand what an ETF is. I think if we start going into the, UCITS and non-UCITS, it gets a little more tricky. But I think generally the concept of it being exchange traded, people understand. I've been quite focused on Italy lately, as it's, one of the markets that I cover. And, yes, there's a big financial education and financial literacy problem. But the group of investors that buy structured products and buy ETPs are very, very, very well educated on what these products are, even to the point of counterparty risk, UCITS, non-UCITS. Like, they know. So the typical buyer of ETPs, I mean, I can kind of speak to our income shares line, because and that would probably be the most interesting, just considering like the similarities with structured products. And it's an investor that's, first of all, these are dividend paying, like yield paying, monthly distribution paying products, which basically harvest option premium to pay these distributions. And it's a yield focused investor, right? So automatically, if something pays a dividend, that's the investor that's interested in it. And many of these will have a portfolio that has both structured notes and certificates and these kinds of options income ETPs, because they're able across, this suite of products to kind of structure a yield generating portfolio in an interesting way.
So you're basically saying that these ETPs and the structure, let's say the structured investment products, are actually kind of complementary, aren't they?
Yeah, absolutely. Absolutely. They both bring their pluses and their minuses. Some of the main differences, structured notes are going to have a maturity date, right? Maybe they're based on a basket of 3 or 4 different equities, for example. The ETPs don't have a maturity date; it's continuous. But you have something that follows the value of the underlying, with no, there are no barriers, for example. So it's very much a matter of understanding how the yield is generated, what underlying exposure you want, and what different like scenario analysis you're happy with, right?
That also brings the question, right? Because you see now the ETFs coming in using the structured or the ETP payoffs into ETFs, right? How do you see that from your perspective?
Yeah, like initially I was a little bit cynical about it, actually, because I was going, okay, so for how many years we've been saying the passive index tracker is going to beat the active manager, over time, right? And that's kind of what I was exposed to for the first years of my career, especially, and it was a dominant narrative. Now we're moving a lot more into active
Mm-hmm.
ETFs, different strategies. And, it's not novel. It's the same strategies we've been using
Yeah.
in other product wrappers. The winning formula from my perspective is what the wrapper offers, and it's the
Yeah.
tradability and transparency and cost, right?
Mm-hmm. Yeah.
Of the wrapper. That being said, so yeah, I was a little skeptical about it,
Mm-hmm.
and I did have to think about it a little bit. But at the end of the day, if you're able to provide the same or similar exposure in a wrapper that is preferable to some investors, I think it's a win-win. And it's also, this transition to active ETFs, which by the way, this year, in the overwhelming majority, more than half of new launches have been active strategies, which I find crazy.
That's very interesting, right? Because for 30 years it was all about passive, low cost, and now we see this shift. Why do you think that is?
I mean, it's a function of the economic and geopolitical scenario, right? There was
Mm-hmm.
a great BBH survey that surveyed investors across the US, Europe, and I think it was Greater China, and asked them a series of questions of where they thought they would allocate in the next year. Obviously, ETF allocations or ETP allocations are a huge focus, but a huge majority of them, I think, so 96% plan to increase ETF allocations over the next 12 months. And active ETF appetite was huge. So it was something like 66% for active over passive strategies in the next 12 months. And 98% plan to increase ETF exposure. Okay, that's fine. But that 66% active strategy,
Yeah.
I thought was staggering. And the reason is there's so much volatility and so much geopolitical uncertainty
Yeah.
that it's pushing us back. The pendulum is now swinging back towards active management, right? They want a
Yeah.
safe pair of hands, someone who's plugged into the market, who's looking every day to execute the strategy. But active strategies are not just the active mutual fund manager who is now launching his mutual fund strategy in an ETF. It's a lot of things, right? It's a lot of the structured product strategies which are now being launched in ETP form.
I find that fascinating because yesterday I was meeting someone and we were talking about the of course the traditional structured products and it's growing massively, especially AUM. And what was interesting is that when I look at global AUM on income structured products, the AUM is grew 32% globally in 12 months. So since June last year to end of this June. And the reason seems to be it's not the traditional ones linked to market cap. It's looking for opportunities, especially with the vol being as it is, single stocks, dividend plays, correlation. All of these things are moving right quite rapidly. You're getting more and more opportunities to get extra income. Do you think that's so you basically agree that that's probably the reason why this growth on active management?
Yeah, I mean, look, I sell income strategies now for a living, but no, also, another trend the survey highlighted was allocation into dividend or income strategies.
Mhm.
And Europe was actually a leader for that. So I think across the board globally, 33% want to allocate to income, and something like 42% in Europe plan to allocate to income strategies. And that's a mix of, okay, I need some, cadence of income coming in, and let's harvest the increased volatility and the opportunities that are coming from these scenarios.
So what do you think? Now we talked about the ETFs. I mentioned the growth of looking at opportunities for structured products. But what about ETPs? What's the next thing? What's in the next innovation in terms of exposure or liquidity without telling us too much?
The next innovation, I mean, everyone's entering the space,
Mm-hmm.
right? I think whether it's mutual fund managers or structured product issuers, if they can launch an ETP product, it's quite topical at the
Yeah.
moment. The next innovation, I mean, we see what the newest products being launched are. Whether they'll take off or not, I mean, I think remains to be seen. But the growth is quite good. You even have like all auto callable ETFs being launched. All
Yeah.
these structures you guys are used to are now also being launched in ETP format.
Okay. And of course, in Europe, which is your focus, what are the most interesting markets that for on the ETP?
I mean, Italy's quite interesting. I mean, it's the one I one of the ones I know best. And it's interesting because there's actually a tax advantage to having an ETP rather than a UCITS ETF. So funny enough, with UCITS ETFs, you cannot offset capital losses
Okay.
with the gains from a UCITS ETF, whereas you can with ETNs and ETCs. So having a dividend paying or a distribution paying ETP, ETN rather, is quite interesting. So typically investors in Italy look at either certificates or they look at ETCs and ETNs to fix that issue. But it's also like on the income side, I think that's huge, especially in Italy, which is has a very big BTP, so government bond buying culture.
Yeah.
FTSE MIB or Italian equity
Yeah.
dividend investing culture. The FTSE MIB yields 4.5%. That's way higher than most equity indices, right? And so, when you talk to income seeking investors, they're looking to create a diversified income stream, right? So it doesn't just need to come from traditional or like natural yield, which is going to be your equity dividends or your government bonds or your corporate bonds, but they're also looking for, interesting diversified ways, which is exactly what options
Yeah.
premium harvesting strategies do, right? It's yield that's generated from something that isn't linked to interest rates and isn't linked to equity returns.
It's very interesting because I also see that on structured products. I mean, more in the counterparty business, more institutional, but a lot of interest on government bonds, not only Italy, but even Middle East with what is happening, US, which of course, because of all their debt, it's the yields are quite high, right? If you think that they are the most safe and they will not go bankrupt. It's an interesting play. So do you see that growth already on the fixed income ETPs? I'm sure it's still small compared with the equities.
I mean, bond yields are decent. They're always going to be a good allocation. Now, I mean, I think we've been trying to play that for the last, I don't want to say last year or so, and yields just haven't come down. We just did get some inflation data out of the US, which came in below expectations, which is slightly helpful. But it's still, I think the jury's still out if this is like the low prices and the high in bond yields. But the options income segment is growing really, really well. And actually the US is 5-6 years ahead of Europe. So I think the first ones were launched in 2014. Whereas Europe, we launched in 2020, the first options income ETPs. So in the US, you have something like more than 850 listed instruments. We're just at like over 110, 120 in Europe. But the AUM difference is huge, right? The US has got more than 290 billion in these, whereas Europe, we're knocking on 9 billion. Flows are good, but we're always a little bit behind. But I think the trend is positive for income strategies in general. It's the right time.
So if you had to give one last message about the income strategies and the ETPs, what will be your message for advisors and for the financial industry?
Well, that's a really tough one. One message besides understand exactly what the strategy is doing before you sell it or before you buy it, I think just make sure that the strategy is the right one for you and that you understand the mechanism behind, an options overlay strategy. You really have to educate yourself on these to be able to use them in the correct way.
Wonderful. Thank you for that. It's been great having you on today. It's been a great conversation. Hopefully we can have more conversations like this in the future. I've learned a lot already myself about ETPs and ETFs. I'm sure our audience had the same thing. How have you found it? Had a good time?
Yeah, I had a great time. Thank you so much. It was really a pleasure. It was great to be able to talk about ETPs and looking forward to speaking to you guys again.
I really appreciate that. Thanks for coming on.
Thank you.